Welcome back to the Deep Dive. Are you ready to unravel one of the most talked about and, let's be honest, often most confusing topics for so many of us?
Tax season.
We're diving headfirst into tax season. Specifically, how to truly optimize your federal income tax filing. Forget feeling overwhelmed by a stack of tax forms.
Right. Our mission today is really to take that stack of highly detailed instructions, the actual guide to itemized deductions, and pull out the most important nuggets of knowledge for you.
Think of it as a shortcut.
Sort of, yeah. A shortcut to being genuinely well-informed about the deductions that can actually reduce your tax liability.
Exactly. Today we're doing a deep dive into Schedule A, the itemized deductions form. We'll break down item by item how to fill it out.
And crucially, focus on the SMART strategies, the specific details that can lead to real tax savings for you.
All right, let's cut right to the chase with Schedule A. What exactly is this form, and why should you, our listener, really pay attention to it when you're thinking about tax savings?
Well, at its core, Schedule A, Form 1040 Schedule A, is where you figure out your itemized deductions. It's incredibly important because, well, in most cases, your federal income tax will be less if you choose to take the larger amount between your total itemized deductions and your standard deduction.
So that's the first big decision point, right? Standard or itemized?
Absolutely. It's your first big tax-saving decision.
Yeah.
Which one gives you the bigger benefit? Which one lowers your taxable income more? That's the goal.
Okay, so if you do decide itemizing might be better, what kind of things are we actually talking about deducting here, generally speaking?
Generally, if you itemize, you can potentially deduct a portion of your medical and dental expenses.
Which we know can be huge.
Oh, definitely. Also, amounts you paid for certain taxes, like state and local income or property taxes, interest, like on your mortgage, contributions to charity, of course, and some other specific expenses, plus certain casualty and theft losses under very specific rules.
Got it. Now, I've heard about this no double dipping rule. Sounds important. Can you break that down?
Yes, absolutely crucial point. You need to remember not to include on Schedule A any items you've already deducted somewhere else on your return.
Like on the main 1040 form. Or maybe business schedule.
Exactly. Form 1040, 1040 SR, or maybe Schedule C if you're self-employed, Schedule E for rentals, Schedule F for farming. If you deducted it there, you can't deduct it again here on Schedule A. It ensures you're maximizing deductions correctly, without errors, one deduction per expense.
Makes sense. And what about married couples who file separately? Does that complicate things for Schedule A?
It can, yeah. If you and your spouse paid expenses jointly, maybe you co-own a house and split the property tax bill or paid medical bills together, but you're filing separate returns for 2024.
Which sometimes happens for various reasons.
Right, you'll need to consult Publication 504. That guide helps you correctly figure out your specific share of those joint expenses for your own itemized deductions. It ensures fairness and, keeps you compliant.
Okay, good heads up there. Let's move into one of the big ones. Medical and dental expenses. This feels like an area where costs are always rising, and maybe there are hidden savings.
This section definitely holds significant tax-saving potential, especially with healthcare costs being what they are. But, and this is critical, it comes with a threshold.
A threshold. Okay, what kind?
You can only deduct the portion of your total medical and dental expenses that exceeds 7.5% of your adjusted gross income, your AGI. That's the number from line 11 on your Form 1040 or 1040 SR.
Can you give us an example of how that works?
Sure. Let's say your AGI is $50,000.
Yeah.
7.5% of that is $3,750. So you can only start deducting medical expenses after you've spent more than $3,750. If your total eligible expenses were, say, $5,000, you could deduct $1,250. That's the $5,000 minus the $3,750 threshold.
Wow, okay, so you really need substantial expenses relative to your income for this to kick in. Understanding that 7.5% AGI threshold is vital then.
Absolutely vital. It's the first hurdle you have to clear when considering your tax strategy here.
So once you potentially clear that hurdle, whose expenses can you actually include? Is it just you and your spouse?
It's broader than many people realize, which is great news for potential tax savings. Of course, you can include expenses for yourself and your spouse.
Naturally.
And for all the dependents you claim on your return. But it goes further.
Oh. Like who?
You can even include expenses for a child you don't claim as a dependent, maybe because of rules for divorced or separated parents. If you paid their medical bills, they might count for you.
That's interesting. What else?
Also, any person you could have claimed as a dependent, except they maybe earned too much income, that $5,050 gross income limit for 2024, or they filed a joint return.
So even if they don't technically qualify as your dependent on the main form?
Right. Or similarly, any person you could have claimed, except you could be claimed as a dependent on someone else's return.
That seems like it could really help caregivers. Can you give a specific example, like for a parent?
Definitely. Let's say you provided over half of your parent support in 2024. Great. But you can't claim them as a dependent because they earned, say, $5,100 in wages, just over that limit.
Okay, so no dependency exemption for them.
Right. But because you provided that support, you can still include the medical and dental expenses you paid for them on your Schedule A. This is a really vital detail for many families supporting aging parents.
That's a fantastic hidden gem. What about insurance premiums for non-dependents, like an adult child still on the family plan?
Good question. Generally, you can't deduct premiums specifically for someone who isn't your dependent, like that adult child under 27 on your policy. However, if you had family coverage anyway, and adding them didn't actually increase your premium cost.
So the premium was the same whether they were on it or not.
Exactly. In that specific case, you can generally deduct the full amount of your medical and dental insurance premiums as long as they otherwise qualify. It's a nuance, but potentially valuable.
Okay, that clarifies who counts. Now, let's dive into what specific payments count. We know premiums, prescriptions, but what are some surprising things that might help people reach that 7.5% threshold?
Right. Let's look at the specifics because every bit helps. Remember, you can only include payments for expenses that were not reimbursed by insurance or anyone else. It's your out-of-pocket cost.
Got it. Premiums first.
Premiums for medical and dental care, yes, including qualified long-term care insurance contracts. But watch out for those age-based limits on long-term care premiums.
Age-based.
Yeah, for 2024, if the insured person was 40 or under, the max premium you can count is $470. But if they were 71 or older, it jumps to $5,880.
The amount scales up with age.
Okay, important detail. And reduce premiums by the self-employed health deduction if you took that.
Correct. And don't deduct premiums paid pre-tax through work, since that money wasn't taxed in the first place.
Makes sense. What else beyond premiums? Prescription medicines, obviously, and insulin. Professional services from a really wide range of practitioners, acupuncturists, chiropractors, dentists, eye doctors, medical doctors, psychologists. The list is pretty long.
So not just MDs.
Not at all. Also, medical exams, x-rays, lab services, doctor-ordered insulin treatments, diagnostic tests like full body scans, pregnancy tests, blood sugar test kits.
What about nursing help?
Nursing help, yes, but only the nursing care portion if they also do housework. You have to allocate. Hospital care, clinic costs, lab fees, those all count. Qualified long-term care services.
And Medicare premiums, Part B, Part D.
Yep. Premiums for Medicare Part B and Part D insurance are deductible. Also, premiums voluntarily paid for Medicare Part A if you were 65 or older and not entitled to Social Security benefits.
Okay, now for the really surprising ones. What might people completely miss?
Okay, how about this? Programs to stop smoking, deductible. And prescription medicines for nicotine withdrawal, also deductible.
Really? Wow. What about weight loss?
Yeah. Weight loss programs can be deductible, but only if they're for a specific disease diagnosed by a doctor. And that includes obesity itself.
Interesting. So not just for general wellness.
Correct. Also, medical treatment at drug or alcohol addiction centers, that counts.
What about physical aids? Glasses, hearing aids?
Absolutely. Eyeglasses, contact lenses, hearing aids, braces, crutches, wheelchairs, even guide dogs or other service animals, including their purchase and maintenance costs.
Maintenance too, like food and vet bills for the guide dog.
Yes, associated costs like that. Also, surgery to improve defective vision, think LASIK, that's generally considered medical, not cosmetic.
And travel. Getting to the doctor can be expensive.
Big one, ambulance service, obviously, but also other travel to get medical care. If you use your own car, you can include actual gas and oil costs. Or use the standard medical mileage rate. For 2024, that was 21 cents per mile. Plus, always add parking fees and tolls to whichever method you use. That mileage can really add up.
21 cents a mile.
Yeah.
Definitely worth tracking. What about staying overnight for care?
You can deduct lodging expenses, but not meals, while away from home primarily for medical care received in a hospital or similar facility. But there are rules. No significant personal pleasure or vacation involved, and it's limited to $50 a night per person.
Okay, $50 per person per night, lodging only. Good to know. Anything else?
One more, perhaps surprising for some. The cost of breast pumps and supplies that assist lactation. Those are deductible medical expenses.
That's a pretty comprehensive list of what is deductible. Now, equally important, What can you not deduct? What are the common mistakes people make?
Right, avoiding mistakes is key. You can't deduct the cost of diet food, generally, unless it's specifically part of that doctor-diagnosed weight loss program we
Okay,
mentioned.
so just buying low-cal food at the store doesn't count.
Correct. Cosmetic surgery is also usually out unless it's necessary to fix a deformity from, say, an accident or birth defect. Purely elective stuff, no deduction.
What else? Life insurance.
Nope. Life insurance or income protection policies aren't medical care. Neither is a Medicare tax on your wages or self-employment income. That's a tax, not a medical expense for this deduction.
Okay. What about child care for a healthy baby?
Nursing care for a healthy baby isn't deductible here. Though, like I said, you might get a dependent care credit for that on Form 2441, so check that out.
Good tip. Anything illegal?
Definitely not. Illegal operations or drugs or imported drugs not approved by the US FDA, none of that is deductible. Non-prescription medicines other than insulin are also generally not deductible. Think over-the-counter pain relievers, cold medicine, etc.
Even nicotine gum if it's not prescribed.
Right. If it's non-prescription, usually no. And travel your doctor just tells you to take for rest. Like a trip to Florida for the sunshine, not deductible. That's personal.
And funeral costs.
No, funeral, burial, or cremation costs are explicitly not deductible as medical expenses.
That clears up a lot. Now, what about reimbursements? Like if insurance pays part of the bill, or if you use a flexible spending account, a cafeteria plan from work, how does that affect the deduction?
Very common scenarios. If insurance or anyone else reimbursed you or paid the provider directly, you only include the amount you actually paid out of pocket. You can't deduct what insurance covered.
Makes sense. What if you get reimbursed later?
If you get reimbursed in 2024 for expenses you also paid in 2024, you have to reduce your deductible expenses by that reimbursement amount. Paid $500, got $200 back, you count $300.
Okay. What if the reimbursement in 2024 is for expenses you paid and deducted last year in 2023?
Ah, different rule. You don't reduce your 2024 expenses. Instead, if that prior year deduction actually reduced your tax in that year, you generally have to include the reimbursement amount as income on this year's return. Schedule 1, line A does. It's like the IRS clawing back the prior benefit.
And those cafeteria plans are FSAs, not taken out pre-tax.
Generally, you can't deduct insurance premiums or medical expenses paid with funds from those types of plans. Why? Because that money was never included in your income in the first place. It wasn't in box 1 of your W-2. Deducting it again would be double dipping.
So the big takeaway here is meticulous records.
Absolutely. For you, the listener, keeping detailed records of all medical expenses is paramount. Receipts, appointment dates, mileage logs for travel, parking, tolls. Everything. Without proof, you risk losing deductions or having issues if the IRS asks questions. Every documented dollar gets you closer to potentially clearing that 7.5% threshold.
Okay, let's pivot from medical expenses to taxes you've already paid. This is another big category, but I know there's a major limitation here, right? The SALT cap.
Yes, exactly. When we talk about deducting taxes you paid, the most significant rule you need to know about is the state and local tax SALT deduction limit. It's generally capped at $10,000 per household.
$10,000 total.
$10,000 total per return, or $5,000 if you're married filing separately. This cap applies to the combined total of your state and local income taxes, or general sales taxes, we'll get to that choice, state and local real estate taxes, and state and local personal property taxes.
So all those state and local taxes get lumped together and capped at $10.
That's the rule. Understanding this limit is crucial, especially if you live in a high-tax state, as it really constrains how much benefit you can get on your federal return.
Before we dig into what does count towards that cap, what taxes are definitely not deductible here?
Good place to start. You cannot deduct federal income taxes,
Right.
or most federal excise taxes. Things like Social Security, Medicare, FUTA, railroad retirement taxes, nope. Customs duties on imports? No. Federal estate and gift taxes? Generally no, though there's that tiny exception for estate tax on income in respect of a decedent, but that goes later on line 16, not here.
Okay, what about state and local taxes that don't count?
Right. State or local gasoline tax, not deductible here. Car inspection fees, nope. License fees, like for your driver's license, marriage license, pet license. Those are fees, not deductible taxes. Also, assessments for improvements that increase your property value, like a new sidewalk assessment. That adds to your home's basis. It's not a tax deduction. And you can't deduct taxes paid for someone else. Foreign, personal, or real property taxes are also generally out for this section.
Got it. Now, you mentioned a choice regarding income versus sales tax for line 5A. Tell us about that strategy.
Yes, this is a key strategic decision you get to make each year. For line 5A, You have to choose. Do you want to deduct your state and local income taxes or your state and local general sales taxes? You cannot deduct both.
So you pick whichever one gives you a bigger deduction.
Exactly. You figure out both amounts or make a good estimate and choose the higher one to include towards that $10,000 overall SALT cap.
Okay, let's break down option 1, state and local income taxes. What goes into that?
If you choose income taxes, you'll include state and local income taxes withheld from your salary during 2024. That's usually in box 17 of your W-2. Also, any state and local income taxes you paid in 2024 for a prior year, like if you owed money when you filed your 2023 state return, but don't include penalties or interest paid with that.
What about estimated tax payments?
Yes, state and local estimated tax payments made during 2024 count, and any part of a prior year's state tax refund that you chose to have applied to your 2024 estimated taxes also counts as paid in 2024.
Anything else for income tax?
Uh-huh. Mandatory contributions you made to certain state benefit funds. Think state disability funds in places like California or New Jersey or state family leave programs. If it's mandatory and run by the state, it often counts as a deductible state income tax.
Good detail. Now, a crucial reminder here.
Don't include any state or local income tax refund you expect to get for 2024. And if you received a refund in 2024 for prior year state taxes, don't reduce this year's deduction. Instead, that refund might be taxable income this year on Schedule 1 if it gave you a tax benefit back then.
Okay, that's income tax. What about option 2? Sales tax. How do you figure that one out, especially if you didn't save every single receipt?
Right, the sales tax option. If you elect this, you have to check the box on line 5A. You've got two methods.
Method.
Actual expenses. You deduct the actual state and local general sales taxes you paid. This means you absolutely must keep all your receipts showing the sales tax paid. It might be worthwhile if you bought a really big ticket item like a car or boat and tracked everything meticulously. You can include tax on food, clothing, medical supplies, even if the rate was lower, and tax on vehicles counts up to the general sales tax rate. Leased vehicles, too.
Okay, that sounds like a lot of work. What's method B?
Method B, optional sales tax tables. This is usually much easier. The IRS provides tables in the Schedule A instructions, or you can use the calculator on irs.gov sale tax.
How do those tables work?
The table amount is based on your state of residence, your income level, and your family size. For income, you use your AGI from line 11 plus certain non-taxable income like tax-exempt interest, veterans benefits, non-taxable Social Security, etc. The instructions list what to add back.
And family size just means dependents.
Yourself, spouse, if filing jointly, and claimed dependents, yes.
What if you lived in multiple states during the year?
You'll need to prorate. You figure the table amount for each state and then allocate it based on the number of days you lived in each state. The online calculator handles this nicely.
Now, here's a potential bonus I heard about. Can you add sales tax from big purchases on top of the table amount?
Yes. This is a fantastic tax-saving detail many people miss. You can add the actual state and local general sales taxes you paid on specific large items to your table amount.
Like what kind of items?
Motor vehicles, cars, motorcycles, RVs, boats, aircraft, if the tax rate was the same as the general sales tax rate. Also, sales tax on a home or a substantial addition or major renovation can be added under specific conditions, like if the tax was imposed directly on the sale or materials, or if your contractor legally acted as your agent.
Wow, so definitely keep receipts for those big purchases, even if you use the sales tax tables.
Absolutely. Adding those can significantly boost your sales tax deduction, pushing you closer to that $10,000 SALT cap.
Okay, that covers the choice on line 5A. What about real estate taxes on line 5B? This is huge for homeowners.
It is. You can deduct state and local real estate taxes you paid on property you own that wasn't used for business. But again, there are rules.
Like what?
The tax must be assessed uniformly across all similar property in the community, and the money must be used for general governmental purposes. It can't be a specific fee for a service.
So like my trash collection fee on the property tax bill doesn't count.
Correct. Itemized charges for services like trash pickup, water fees, or assessments for improvements that increase property value, like that new sidewalk, are not deductible as real estate taxes. However, an assessment just to maintain an existing public facility, like repairing an existing sidewalk, that can be deductible.
Subtle distinction. What if taxes are paid through mortgage escrow?
You can only deduct the amount the mortgage company actually paid to the taxing authority during 2024. That's usually shown on your Form 1098, not the total amount you paid into escrow.
And if you sold your home?
Any real estate tax charged to the buyer on the settlement statement reduces your deduction. It's considered a refund to you. Also, remember the prepayment rule. You can only deduct taxes paid in 2024 that were assessed before 2025. You can't prepay and deduct 2025's taxes in 2024.
Got it. What about line 5C, personal property taxes, like on a car?
Right. State and local personal property taxes, these are deductible only if they are based on the value of the property alone and are charged on a yearly basis.
So my car registration fee.
If part of it is based on the car's value and part is based on, say, its weight, you can only deduct the portion that's based on the value, the weight-based part, not deductible.
Value only.
Yeah.
Okay. And finally, line 6, other taxes. What goes there? It sounds like a catch-all.
It's really not a catch-all. It's for very specific taxes not covered above, like income taxes paid to a foreign country. But, quick tip, you might be better off taking a foreign tax credit instead of this deduction, as a credit usually saves you more tax.
Good point. What else for line 6?
Generation skipping tax on certain income distributions, that's pretty uncommon. Do not include taxes paid to a U.S. territory here. Those go on the state-local lines, 5A, 5B, 5C. And definitely don't put federal estate tax on income in respect of a decedent here that has its own spot on line 16. It's a very narrow category.
Okay, that covers taxes. Let's move on to interest. This area feels nuanced. Not all interest is deductible, right? But home mortgage interest is a big one.
Exactly. It's nuanced because generally, personal interest is not deductible. Think credit card interest for personal stuff. Car loans. Nope. The focus for itemized deductions here is primarily on qualified home mortgage interest and investment interest.
And if a loan was used for multiple things, like part home improvement, part debt consolidation,
You must allocate the interest. Trace where the money went. Only the interest on the portion used for qualifying purposes, like the home improvement part, is potentially deductible here, the debt consolidation part. Likely not deductible as home mortgage interest.
Okay, let's dive into home mortgage interest, lines 8A and 8B. What qualifies?
A home mortgage is basically any loan secured by your main home or a second home. The home just needs basic living accommodations, sleeping space, toilet, cooking facilities. So yes, sometimes boats or RVs can qualify if they meet that test.
Interesting. And it includes HLROCs, second mortgages.
Yes, first and second mortgages, home equity loans, refinanced mortgages, as long as they're secured by the qualifying home.
Now, the big limits. This seems crucial for tax savings.
Absolutely crucial. Several limits apply, and they often require you to consult Publication 936. First big one, use of loan proceeds.
We touched on this. Buy, build, or substantially improve.
Correct. You can only deduct interest on the portion of the loan used to buy, build, or substantially improve the home securing the loan. This is qualifying debt. If you took out a home equity loan and used it to pay off credit cards, the interest on that part is not deductible as home mortgage interest.
Even though the loan is secured by the house.
Even then, the use of the funds dictates deductibility here. This is a major area people misunderstand. Interest on funds used for business or investment might be deductible elsewhere, but not here.
Okay, use of proceeds is key. What about debt amount limits? I know this changed recently.
It did. It depends on when you took out the loan. For qualifying debt taken out on or before December 15th, 2017, you can deduct interest on up to $1 million of that debt. $500 if married, filing separately.
Okay, the older grandfather debt.
Right. But for qualifying debt taken out after December 15th, 2017, the limit is lower. Interest is deductible only on up to $750,000 of that debt. $375K if married, filing separately.
And if you have both kinds of debt, old and new.
The $750K limit on the newer debt gets reduced by the amount of your older pre-16th, 2017 debt. It gets complicated quickly, so Pub 936 is your friend here.
Goodness. Any other limits?
Yes, if the total amount of all your mortgages is more than the fair market value, FMV, of the home, your deduction might also be limited. Again, see Pub 936.
Okay, so assuming you're within the limits, how do you report this? Line 8A?
Mostly, yes. The interest and points reported to you on Form 1098 usually go on line 8A. But if any of those limits apply, you calculate the deductible amount using Pub 936 and enter that amount on 8A.
What if Form 1098 shows a refund of overpaid interest?
Don't reduce your deduction. That refund might be income on Schedule 1, line 8D, similar to tax refunds.
And if you paid interest to someone who didn't send a Form 1098, like seller finance,
that goes on line 8B. And this is critical. You must provide the recipient's name, identifying number, like their SSN or EIN, and address right there on the dotted lines.
You have to put their info on your return.
Yes. And you also have to let them know your social security number. If you fail to provide the recipient's info or your SSN, you could face a $50 penalty. So definitely follow through on this if you're deducting seller-financed interest.
Okay, important compliance point. What about points on line 8C? Those fees paid at closing.
Points, yeah. They're basically prepaid interest. Points you paid only to borrow money are generally deductible, but usually over the life of the loan, not all at once.
Spread out over 15 or 30 years.
Typically, yes. Now, a tax-saving strategy with refinancing. Normally, points paid to refinance must also be deducted over the life of the new loan.
However,
Good news. Potentially.
Mhm.
If you used part of the refinance proceeds to substantially improve your main home, you might be able to deduct the portion of points related to that improvement in the year you paid them. That accelerates the deduction significantly.
nice. Any other point strategies? Like paying off the mortgage early.
Yes. If you pay off a mortgage early, you generally get to deduct any remaining undeducted points in that final year. Catches you up on the deduction. Though there's a small exception if you refinance with the same lender, so check Pub 936 if that's you.
Okay, good tips on points. Now, line 9, investment interest. What's that about?
This is interest on money you borrowed specifically for property held for investment, like a margin loan to buy stocks or a loan for investment property that's not a passive activity. It does not include interest related to passive activities or tax-exempt bonds.
And you usually need a special form?
Generally, yes. You need to complete and attach Form 4952 to figure this deduction, which is limited to your net investment income.
Is there any way around Form 4952?
There is a handy exception for you. You don't have to file Form 4952 if all three of these are true. 1. Your investment interest expense is less than your investment income from interest and ordinary dividends, minus qualified dividends. 2. You have no other deductible investment expenses, A and D3. You have no disallowed investment interest carried over from 2023. If you meet all three, you can skip the form.
Okay, helpful shortcut potentially.
Yeah.
Let's move to gifts to charity. This is where doing good can maybe do your tax bill some good too, right? But I hear the rules are strict.
You're absolutely right. Giving back can lead to tax benefits, but the rules, especially around record keeping, are very specific. You need to make sure your generosity actually counts for tax savings.
So first step,
Yeah.
what's a qualified charity? Does every nonprofit count?
Not necessarily. We're talking about organizations that are religious, charitable, educational, scientific, or literary in purpose, or groups working to prevent cruelty to children or animals. Churches, synagogues, mosques, groups like the Red Cross, Salvation Army, Scouts, Boys and Girls Clubs, United Way. Most nonprofit hospitals, universities, but not if your donation is basically tuition, and medical research groups. Also, gifts to federal, state, or local governments if they're solely for public purposes.
How can you be sure an organization qualifies?
Great question. The IRS has an online search tool. Just search for IRS TOs or tax-exempt organization search. It uses the publication 78 data. Definitely check if you're unsure, especially for smaller or local groups. It's a crucial step.
Okay, assuming it's qualified, what kinds of gifts can you deduct? Just cash.
Nope. Various ways. Cash or check contributions, obviously. You deduct the amount given. Property donations, too, like clothing or furniture, you generally deduct their fair market value at the time you donated them.
What about used items, like bags of clothes?
Generally, donated clothing and household items must be in good use condition or better to be deductible. There's an exception if you deduct more than $500 for a single item, but then you need a qualified appraisal.
Good condition or better. Okay, what about volunteer work? Can you deduct your time?
You can't deduct the value of your time or services, unfortunately, but you can deduct your out-of-pocket expenses while volunteering.
Like driving.
Yes. If you use your car for volunteer work for a qualified charity, you can deduct your actual gas and oil costs or use the standard charitable mileage rate. For 2024, that's 14 cents per mile. Plus, always add parking and tolls. Just don't deduct any costs the charity reimbursed you for.
14 cents a mile. Lower than medical, but still adds up for active volunteers. What if you get something back for your donation, like tickets to a gala?
Ah, the quid pro quo contribution. If you receive a benefit in return food, entertainment, merchandise, you can generally only deduct the amount of your contribution that is more than the value of the benefit you received.
So if I pay $100 for a charity dinner worth $40,
You can only deduct $60. The charity should tell you the value of the benefit. There are exceptions for token items or certain membership benefits, but that's the general rule.
okay, now the part that trips people up. Records. What do you absolutely need to keep to prove your donations.
This is critical for your tax savings. For any cash contribution, no matter how small, you must keep either a bank record, like a canceled check, bank statement, credit card statement, or a written record from the charity showing their name, the date, and the amount. Just dropping cash in a collection plate without getting something back. Technically, not deductible without proof.
Wow, okay. What about bigger donations, say $250 or more?
For any single contribution of $250 or more, cash or property, you must have a contemporaneous written acknowledgement from the charity. This is non-negotiable.
What does contemporaneous mean? And what needs to be in that letter?
Contemporaneous means you must get the acknowledgement by the date you file your return or the due date, including extensions, whichever is earlier. The acknowledgement must state the amount of cash and describe any property donated. It also must say whether the charity gave you any goods or services in return, and if so, provide a good faith estimate of their value.
You keep this letter. Don't send it with a return.
Correct. Keep it with your records. Also note that separate payments aren't combined. If you give $100 each month, those are separate $100 gifts, not one $1,200 gift requiring the acknowledgement.
Okay, what about non-cash property donations over $500?
If your deduction for all non-cash gifts is over $500, you must complete and attach Form 8283, non-cash charitable contributions.
For items over $5,000 or certain clothing household items over $500, you'll likely need a formal appraisal too.
And cars, boats, planes.
If you donate a motor vehicle, boat, or airplane and claim over $500, you generally must attach a copy of the acknowledgement statement you get from the charity they often use, Form 1098-C. The rules are very specific here based on what the charity does with the vehicle.
So records. Are there limits on how much you can deduct overall? Yes, there are annual limits based on a percentage of your AGI. Generally, cash contributions are limited to 60% of your AGI, but certain types of contributions, like to private foundations or donations of capital gain property, have lower limits, like 20% or 30%. If your donations exceed these limits, you might not be able to deduct the full amount this year.
What happens to the excess? Is it lost?
No, thankfully. You can generally carry over the excess contributions that you couldn't deduct due to AGI limits and deduct them in the next 5 years, subject to the same percentage limits in those years. Pub 526 has all the details.
Okay, good to know about carryovers. Now, to avoid mistakes, what definitely can't you deduct as a charitable gift?
Lots of things people might assume are deductible. Contributions where you get a state or local tax credit in return are generally not deductible federally. Amounts paid to a college for the right to buy athletic tickets. Nope.
Travel for fun disguised as volunteer work.
Right. Travel expenses if there was a significant element of personal pleasure, recreation, or vacation. Political contributions. Never deductible as charity. Dues to country clubs, lodges, fraternal orders. Generally, no.
Raffle tickets. Bingo.
Cost of raffle, bingo, or lottery tickets. Not a charitable gift. Though remember, non-winning tickets could count as gambling losses up to winnings on line 16. The value of your time or services, not deductible. Value of blood donated, nope.
Gifts to individuals or foreign charities.
Gifts directly to individuals, no. Gifts to groups operated for personal profit, no. Gifts to most foreign organizations, generally no, with a few exceptions. Gifts to groups that lobby heavily, no. And tuition payments. Definitely not a charitable donation. Look for education credits instead.
That's a helpful list of what to avoid. What about line 13, carryover from prior year? You mentioned that briefly.
Yes, if you had contributions you couldn't deduct in a prior year because of those AGI limits, you enter the carryover amount here on line 13. Remember that 5-year carryover period. It's a valuable way to make sure past generosity eventually provides a tax benefit. There's a specific note for carryovers from 2020 or 2021. They're subject to a 60% limit if deducted in 2024. Always track your carryovers.
Great advice. Okay, we're nearing the end of the specific deduction categories. Let's talk about the less common ones, casualty, theft, and other itemized deductions. These might not hit everyone, but could be huge if they do. Why?
Exactly. These cover specific situations. Let's start with casualty and theft losses on line 15. The rules here changed significantly a few years back.
How so?
You can now only deduct personal casualty and theft losses if they are attributable to a federally declared disaster.
Wait, only if the president declares it a disaster area. So my car getting stolen from my driveway or a tree falling on my house in a regular storm, that doesn't count anymore for deduction.
For personal property losses, unfortunately, no. Unless it happens within a federally declared disaster zone and as a result of that disaster, it's a very strict limitation now.
Wow. And even if it is a federally declared disaster loss, are there other hurdles?
Yes, 2 thresholds. First, each separate casualty or theft loss must be more than $100. You reduce each loss by $100 first.
Okay, $100 deductible per event.
Then, the total amount of all your disaster losses for the year, after applying the $100 reduction to each, must be more than 10% of your AGI, from line 11 of Form 1040.
10% of AGI. That's a high bar, too.
It is. It means only really significant losses from federally declared disasters will result in a deduction. You'll need to use Form 4684, Casualties and Thefts, to figure out the deductible amount.
Okay, that's a tough one. What about line 16, other itemized deductions? Is this finally the miscellaneous catch-all?
I wish, but no, line 16 is not a catch-all. It's a very specific, limited list of deductions. Don't just throw random expenses here. You need to list the type and amount of each specific deduction claimed here.
So what does go on line 16?
One common one is gambling losses. But remember the key rule: you can deduct gambling losses, including the cost of non-winning lottery, bingo, raffle tickets, only up to the amount of your gambling winnings that you reported as income on Schedule 1.
So losses can only cancel out winnings. They can't create a net loss deduction against other income.
Precisely. Won $1,000, lost $5,000. You can only deduct $1,000 of losses on line 16. Keep good records of both.
Okay. What else for line 16?
Casualty and theft losses of income-producing property. These are different from personal losses and have different rules than damage to a rental property. Federal estate tax paid on income in respect of a decedent, that rare situation we mentioned, amortizable bond premium, certain losses on specific debt instruments.
These sound pretty technical.
They are. Also, repayment of amounts under a claim of, right, if it's over $3,000, basically repaying income you were taxed on previously. Certain unrecovered investment in a pension. Impairment-related work expenses for a person with a disability. It's a very specific list.
Got it. Now, I heard something interesting about disaster losses for people who don't normally itemize.
Yeah.
Can they still get some benefit?
Yes. This is a great feature. If you have a net qualified disaster loss from Form 4684 from a federally declared disaster, but your other deductions aren't enough to make itemizing worthwhile.
So you'd normally take the standard deduction.
Right. You can claim an increased standard deduction. You actually list the disaster loss amount on the dotted line next to line 16 of Schedule A, noting net qualified disaster loss. Then you list your regular standard deduction amount next to it, noting standard deduction claimed with qualified disaster loss. You add them together on line 16, fill out Form 4684, and enter the total on your Form 1040. You don't fill out the rest of Schedule A.
So you add your disaster loss to your standard deduction. That's huge.
It is. It allows you to get tax relief for that disaster loss, even if you don't normally itemize. A very helpful provision.
Absolutely. Okay, we've covered all the categories. So after painstakingly calculating all these potential deductions, what's the final step? How does this all come together?
Right. Line 18 of Schedule A is where you total everything up. Add up all the deductions we've discussed, the deductible part of medical, the capped state local taxes, the qualified interest, charitable gifts, those limited casualty losses, and the other specific deductions from line 16. That sum is your total itemized deductions.
And then the moment of truth.
Exactly. The critical step is to compare this total on line 18 to your standard deduction amount for your filing status. You then take the larger of the two amounts.
Whichever number is higher gives you the bigger tax break.
Precisely. That's the ultimate tax-saving choice on your return. Pick the larger number itemized total or standard deduction to subtract from your income. That determines your taxable income.
Is there ever a reason to itemize federally if your itemized total is less than the standard deduction?
It's uncommon federally, but yes, potentially. Some states have different rules, maybe lower standard deductions or require federal itemizing to itemize on the state return. So in rare cases, someone might choose to itemize federally even if it's lower, purely for state tax benefits. But for most people, federally, you just take the bigger number.
This deep dive into Schedule A has really opened my eyes to just how many layers there are to optimizing your tax filing. It's not just about having expenses, it's about knowing the rules.
From tracking those medical miles to understanding the precise limits on mortgage interest based on when you got the loan to getting the right acknowledgement for charity. Every detail matters.
It really shows that the potential for tax savings is there, but it requires attention and, frankly, good record keeping.
Absolutely. If there's one key takeaway from all this detail, it's the power of proactive and diligent record keeping throughout the entire year. Knowing what documents to save, what information you'll need for each deduction category that is your ultimate tax-saving strategy. It's not something you can easily recreate in April.
So maybe a provocative thought for you, our listener. As you hear these detailed rules, the AGI floors, the caps, the specific requirements, what does that tell you about the government's priorities? What behaviors are being encouraged or discouraged? And how might that influence your financial planning for next year? Maybe it really is time to start that dedicated tax folder for 2025 right now.
That's a great way to think about it. And while we've covered a lot today, please remember your personal tax situation is unique. Tax laws can be complex, they can change. Consulting with a qualified tax professional is always a good idea for tailored advice to make sure you're maximizing every possible deduction for your specific circumstances and staying compliant.
Couldn't agree more. Thank you so much for walking us through this incredibly detailed landscape, and thank you for joining us on this enlightening deep dive into tax saving strategies. Until next time, keep learning, keep questioning, and keep getting informed.